So if the hedge funds go into a mode where they start selling everything that's not nailed down in their office when the stock market goes into crash mode, then yeah, I think we'll get a brief down ride on the elevator with a broken cable with gold, but I think it'll be brief.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and we are digging back into the chaos that we've been witnessing in the financial markets over the past couple of days and weeks, but particularly in the bond market, as well as carrying over to the gold and silver markets. And fortunately, I'm joined by my dear friend Dave Kranzler of Investment Research Dynamics, who we're going to pick his brain today on some of the things that he is seeing going on out there in a rather volatile time that has a lot of people concerned. We're seeing some big moves in bonds in particular, getting to the point, perhaps one could describe it as disorderly. And with that said, Dave, great to have you here. It's been a while since we did this together, but nice to see you today, especially in front of your beautiful Fortuna ounce there. And how are you doing, my friend?
I'm doing well, thank you. Can we just correct something here?
Sure.
It's more like you're joining me on my bi-weekly podcast, but I let you take the lead because I feel bad for you because the Broncos are about ready to put a hurting on the Jets this Sunday.
Well, we'll see about that. As Dave is mentioning, part of the reason we're doing this together is before the season. Dave is a big Broncos fan. I'm a big Jets fan, and we bet an Eagle on wins outright for the year, as well as two Eagles on this week's game. And Dave, you were saying before we started recording, we both had a little bit more optimism about the season about 5 weeks ago. Has not gone quite as planned for either of our squads. And before we dig into bond market chaos and all that other fun stuff, any thoughts on what we're going to see this weekend? I know in addition to the Short Sellers Journal and the Mining Stock Journal, we might one day have Dave's football picks. So how do you see things breaking down this weekend?
I just want to say, the Jets issues, I mean, they have a great defense, right? Their issue is explainable because their franchise quarterback went down in the first half of his first game as a Jet. Aaron Rodgers.
4 plays in.
Yeah, 4 plays in. So I mean, at least it's emotional solace to know that that it was something that's beyond your control. Now that said, any given Sunday, the Jets have a great defense. Maybe Zach Wilson, has a conversation with his God, and God helps him out, and the Holy Spirit's with him, and he pulls off a miracle. So that's what I think is going to happen this Sunday. How about you?
Oh, I think there's a chance, although it's interesting the last couple of weeks on Sunday watching football, it feels like the silver market is already open. So
it opens before the afternoon games are over.
By the time the game is done,
right?
The silver market opening in the Far East already down a little bit, but we'll hope for the best and look forward to having some fun with that this weekend. Although on to something that has
I need to correct one more thing here.
Please.
And this ties into this idea that when people, I mean, we can talk a little bit more in depth about this in a few minutes, but a lot of the downward price action we're seeing is only occurring in the paper gold market, the derivatives market. It occurs when the COMEX is open either electronically or the official floor hours open at 8:20 New York time, right? So when the access, it used to be called the access, when the Globex system kicks back in at 6 p.m. New York time, 4 p.m. my time on a Sunday, the Eastern markets, the Far East markets aren't open yet, right? They're not open for trading. Australia, I think, opens, I don't know, maybe an hour later. So when the first hour or so of trading, and I need to check on the Australian trading hours, but there's not physical markets in the Eastern Hemisphere trading at that point in time, and I don't consider Australia the Australian markets to be physical trading markets. I mean, yeah, they produce a lot of gold over there, but it's not like, the gold miners at Sunday at 6 p.m. New York time decide to unload a truckload of gold on the COMEX. It's electronic trading is what's going on. There aren't physical bourses that are open and trading. So, and it's like that early, like this afternoon when the Globex system kicks up again. For the first 30 minutes, 60 minutes, it's digital gold trading. It's not real, there's no real gold changing hands. So and that's my contention. But I guess what I kind of wanted to talk about today is that the current, and I've mentioned this many times, it's not my original thinking. There's a lot of people who feel the same way. But what's going on right now is startlingly similar to what was going on in the economy and the financial markets and in the precious metals sector in the late summer and fall of 2008. And I think this time, the credit event that's going to hit our system is going to be worse than what we saw in 2008. And we can get into that with some of the charts that I've prepared.
Yeah, and that's something that we did want to touch on today. And here's the Kitco chart of gold in 2008 was over $1,000 in March. Interesting, you saw that drop. That was when it dropped to 900, right around when Bear Stearns was taken over by JP Morgan. Certainly some unusual activity that happened then. And then go a couple months forward into late October, gold around 700. That's something that I keep in the back of my mind and am somewhat concerned about, where certainly if you have a crisis that would seemingly boost gold and silver in the medium term, although I'm wondering, how worried are you that we could see, whether it's margin selling or just the various factors going on, that we do continue to get problems with the banking sector, in the interest rate markets? How concerned are you about a big move down in gold and silver, even if it's just in the short term?
That's a fantastic question. And you know what, you were right. I remember now. I was thinking gold might have gotten up to like 1,200 back then, but it was March of 2008. Gold hit. I think it actually topped out. The futures topped out at 1,035, if memory serves me, because I remember I was trading gold futures from a condo at Crested Butte in the morning before we went out to ski, and I remember all of a sudden watching gold start to get pummeled, and it briefly hit in the futures market 1,035, and then it obviously traded down to 700, almost went below. I think it went for a couple ticks below 700 quickly. And then, and that was in October of 2008. And silver, I think, almost hit 20 back then, if I recall.
21 cannot.
But anyway, Ray, this is a great question, and ahead of time, I didn't know you were going to have this question, so I didn't get a chart prepared to illustrate what I'm talking about here. But we went over it before we, started recording. And whenever there's been, a cliff dive in the stock market, gold's had different responses. So, back in 2008, and I'm just looking at a weekly chart here with the price of gold overlaid on it. So I don't have it in front of me, unfortunately. I don't have it to share with the screen, unfortunately. But so gold, the market back in 2008 went into cliff dive mode, starting in like mid to late September, and it dropped quickly. If you look at the weekly chart, it goes straight off a cliff. Gold on a slightly delayed basis followed the stock market lower, but it followed the stock market lower for maybe 3 weeks. So it went into cliff dive mode for maybe 3 weeks, and then all of a sudden And it might have taken the announcement that Bernanke said that they were going to start printing money again, and gold shot up. I mean, and obviously it had a 3-year run that took it up to almost 2,000. And the stock market at that point kept going lower. In fact, it went down between the end of October and I think it was, call it, mid-March. It went down almost as much on a points basis as it went down from the early summer to the end of October. So and then it had a brief bounce at the end of 2008. But and then as we talked about this, there were two periods, one in mid to late 2015, and most people probably remember also the market crash in late 2018. When Powell came out the day after Christmas, and they obviously orchestrated this and said they were going to start cutting rates, and the stock market shot up. But the stock market had two cliff dive periods in late 2015 and late 2018. By the time the stock market went into cliff dive mode, gold had already had the snot kicked out of it. All right. And so I'm just looking at the chart here. And when the market went into cliff dive mode in both of those times, gold started moving higher as the market was going down. And then we talked about that time when I was on the phone with my business partner. I think it was May 2010, and he was on the golf course. And he's checked in, and he goes, "What's going on?" I said, "What's going on? The Dow's down 1,000 points." He's like, "What? The Dow's down 1,000 points?" He said some old guy was getting ready to hit his putt and heard him say that and almost had a heart attack. So, and gold went down with the stock market, and then when the Dow crossed over from down 500 to down 600, gold did a U-turn, followed by silver, and then followed by the mining stocks. And gold and silver, I believe, both closed green that day, and I think the Dow closed down around 800 or 850. And the mining stocks, I was just using the Huey if memory serves me, the mining stocks went green for a while. They might have closed red. So, people can check that, but you can verify the price action if you want on your own. And then we had, of course, the crash in 2020 that was related to, the COVID nonsense. And the stock market actually started tipping over that year in early January, before anyone knew what COVID was. And but gold went into crash mode very briefly along with the stock market in March that year. But then gold started moving higher a few days ahead of the stock market. So, I mean, yeah, I think I think the stock market at some point will go into crash mode. But with gold, it could go either way. You could get a situation where the hedge funds, and retail's not, and high net worth guys aren't a significant part of COMEX futures. So I'm not worried about margin calls from them, but I'd be worried about margin calls from the hedge funds. So if the hedge funds go into a mode where they start selling everything that's not nailed down in their office when the stock market goes into crash mode, then yeah, I think we'll get a brief down ride on the elevator with a broken cable with gold. But I think it'll be brief. And then I think, because the banks will step aside and see how well they can get their shorts covered. But at some point, I think gold and silver will do a U-turn and head higher. And I don't know what the stock market will do after that. It would probably depend on what the Fed does or how the Fed reacts. So that's my thinking there. I think what you got to do, I think the mining stocks are already, they could go lower, but they're not going to go a lot lower than where they are now. But I think what you got to do is if the stock market goes into crash mode and gold and silver, and again, it's going to be in the futures market. It's not going to be like, China calls up their broker on the LBMA and unloads 10 tons of gold on the LBMA. They're not going to be physical gold selling in quantities. So I think if the market does go into if gold and silver do go into brief crash mode, just realize sit on your hands, realize it's in the only going on in the paper market, and try not to have a heart attack.
Good advice. And I think what a lot of gold and silver investors might have been trying to do these past couple of weeks. Now, Dave, in there, you mentioned a lot of this is based on what the Fed is going to try and do. And you've talked quite a bit before in some of your previous reports about the reasons why it seems like inevitably they're going to have to start QE again. And let's pull up the bond chart where we can see quite a spike in yields, as people are well aware of. On Wednesday, got as high as 4.88%, has come back in a bit since then. We're recording late Wednesday afternoon. What do you feel is driving this? I mean, we have the inflation government numbers starting to tick back up again. Obviously, you have the Fed raising rates higher for longer, but seems like this has really accelerated, and I'm curious what you feel is really the main driver behind this move we've seen, which has occurred primarily in the last month since the last Fed meeting. Is it just the Fed, or do you think there's more going on here than that?
Well, I think there's quite a bit more going on than that. I think, I mean, we don't have to follow my charts in order. I mean, if you want to pull up the chart 5, just to kind of illustrate what it's done to what that, what the move's doing to bond prices. Yeah, I mean, you can see where that move you're talking about. Well, I can't, that last little cliff dive there from almost 1.8, yeah, right there. I mean, that's probably that rise in interest rates, that you show on the screen. I mean, to begin with, I think it's a supply and demand issue, right? You've got China is they're not reloading the treasury bonds that mature that they hold, and they've been selling treasury bonds, right? I mean, look, they've sold nearly $500 billion treasuries since 2013, and it's accelerated since the middle of 2021, right? Why, the US, and I don't care what anyone says, real interest rates are still negative. That calculus that uses the tip yield, right? The Treasury inflation protected securities yield. That's a flawed metric because it's derived from the consumer price index. And it slays me, blows my mind that there's a lot of people out there who know that the CPI is flawed. And they know that the government manipulates the CPI to try and cover up the real rate of inflation. And yet they point to the tip yield calculus as a measure of real interest rates. Well, they're not, because the real inflation rates probably double what the CPI is telling us. So that means real interest rates are still negative. And that's when you have negative real interest rates, it devalues the value of the dollar. So, and that it's not lost on the Chinese. I mean, I would argue that the value of the dollar index, and we won't get into it today, but the dollar index isn't rallying because it's king dollar and everyone's fleeing for safety to the dollar. The dollar index and does not reflect the full devaluation of the dollar that's occurred between 2008 and now from the money printing.
Right.
So, and so, because of that, the yield at the long end of the treasury curve does not reflect the amount of risk that's involved when the dollar resets, because it will reset lower at some point. And so I think if you have to buy treasuries, I think you're nuts if you buy anything longer than 12-month bills, right? Because you can get well north of 5% on a T-bill. So why would you invest in a 10-year treasury under 5%? I mean, you're not even remotely getting compensated for all the risk that's involved. That's involved with investing that far out at under 5%. Because first of all, you're losing value to the dollars that you're investing in there, because rates are negative. Real rates are negative. and the dollar is going to continue to be devalued. You know, unless the Fed has some plan, is colluding with the other Western central banks and the governments to collapse the system, they're going to have to print money again at some point. So it's kind of a long-winded way of explaining one of the variables that is forcing interest rates higher. So I think I think it's dawning on, you know, investors, and I'm not talking about retail guys or high net worth guys, hedge fund guys, professional investors that run big pools of capital. It's like, why am I buying a 10-year under 5% when I can buy a T-bill at well over 5%, or put my money in a money market? And you're seeing that in the flows now, because money markets keep getting more and more cash every week, and money's flowing out of banks, out of deposit, out of demand accounts. So that's part of it. I think also the rising yields at the longer end of the curve reflect all of a sudden it's dawning on the market that, yeah, inflation's kicking back up, and there's risk, especially with what's going on with energy prices, labor strikes. Businesses have to raise, they're still raising their prices to cover the cost of doing their businesses. That inflation, you know, it's not transitory. The hike, the interest rate hike from 0 to, where are we, 5.5% or 5.25% to 5.50, whatever the hell the Fed funds range is, that hasn't slowed down inflation. I mean, if anything slowed down inflation, it's been because Biden, you know, has unloaded a substantial portion of the Strategic Petroleum Reserve to get energy prices down. Well, that was a quick fix, and it was also short-lived. Well, guess what? I'm paying more for gasoline now than I have at any point, maybe in my lifetime, except, you know, at least in Colorado. Obviously, you know, if I go to Aspen, I'll pay a lot more in Aspen than I will here. If I go to New York, I'll pay a lot more in New York. But in Denver, I'm paying the most that I've ever paid for gasoline ever that I can recall. So I think inflation expectations have ratcheted back up. I think the Fed's probably good for one more rate hike, you know, and maybe the long end is adjusting to that expectation after the last Fed meeting. You know, I don't think the Fed's going to maybe they'll keep hiking rates. I don't know. Do they want to, you know, continue crashing the economy? Fine, keep hiking rates. If you want to attack inflation, start reducing your balance sheet at a much quicker rate, and start pulling liquidity out of the system at a much quicker rate. You know, but they know they can't do that, because that'll definitely collapse the system. You know, they're trying to do it. They're trying to pull out gradually, you know, like when the condom breaks. Pull out slowly, honey, maybe nothing will leak, right? Well, that's a bunch of BS, because we're not headed for a soft landing. We're headed for a very hard landing. So, you know, and now, so not only, I think, do you have sophisticated investors finally shifting their capital allocations from the long end to the short end, and I also think it's going to, you know, I think it also means there's going to be a lot less investors, foreign and domestic, that when the Treasury starts to issue longer dated paper in droves, which they'll have to at some point, because if they keep issuing, you know, short-term paper to finance the spending deficit, they're going to keep driving short-term rates higher, because out of sheer supply and demand. So I think in order to attract money into the longer end of the curve, you're going to have to see the long end of the curve go a lot higher in rates. Otherwise, why the hell would you buy a 10-year? Why would you buy a 7-year? Why would you buy a 5-year?
And something you've mentioned, as we've talked about in the last couple of days, is that you're hearing concerns about Bank of America. I mentioned previously on the show how there was that Wall Street on Parade article that showed they had $106 billion in held to maturity unrealized losses. How much higher do you think this market can handle rates before things like that start to pop up? And what are you seeing in terms of weakness in the banking sector at this point?
Well, it's already popped up, right? We had the three largest bank collapses in U.S. history last March, right? Last spring. So I believe they were the three largest. If not, there were three of the four largest. I don't remember the sizes of the banks that went under.
Washington Mutual was first, and those were 2, 3, and 4.
Okay, yeah, there you go. So I mean, just to put some more context on that Wall Street on Parade article, Bank of America's unrealized losses on their held to maturity portfolio, right? And let's make no mistake, the reason why the reason why banks shift their long duration assets into the HTM categories because they don't have to recognize unrealized losses on through in their income statement. That was, I believe, that was one of the genius legal accounting changes that was made after the great financial crisis. So Bank of America's unreal losses are 34% of the total hold to maturity losses reported in aggregate by 4,645 banks. So all the banks that report to the Fed, their hold to maturity unrealized losses in their portfolio, Bank of America's HTM losses represents 34% of that number. And then I did some further refinement to the Wall Street on Parade numbers. The hold to maturity losses, the hold to maturity portfolio on Bank of America's balance sheet is 20% of Bank of America's total balance sheet size, the size of Bank of America's balance sheet. So think about that for a second. They're sitting on, massive hold to maturity losses. If they, for some reason, and these are probably among their most liquid assets, they can't go out and sell credit card loans. They're defaulted credit card loans. They can't go out, and sell, a lot of their commercial real estate holdings. Who the hell's going to buy it? I mean, you're stepping on landmines if you buy that crap. So this hold to maturity portfolio is probably their most liquid asset, other than maybe if they have some T-bills. So, if they get a run on their deposits, what are they going to sell to cover that, right? That's how those three regional banks blew up. So that's just, Bank of America, and that's just one sign. I have a chart in there somewhere that you had pulled up earlier, and that shows credit card delinquencies at all the banks except the top 100. So a lot of these regional banks, they're a little more lenient with subprime bank credit card loans, things like that, and so you can see the delinquency rate was higher than it was in 2019 and 2020, and we know the banks were in trouble in 2020. That's when that so-called temporary overnight repo program was started in September that year. That's because the banks needed liquidity. They were about ready to face a liquidity crisis, and the overnight repos turned into 1 week in duration, then 2 week in duration, then we're just going to hand the banks some money, and when they decide to pay it back, they pay it back. And that's what led to, it wasn't the COVID thing per se, COVID nonsense per se. The Fed needed an excuse to throw $3 trillion all at once into the banking system, and I think they ended up eventually putting $4 trillion in. But if you remember, I think it was a $3 trillion injection pretty much all at once. So, and that's because the banks and the whole system was tipping over then. And now we're back to where we were then. It may be worse. I mean, the credit card delinquencies are worse. You got student loan payments kicking in. You've got, obviously the commercial real estate issue with commercial real estate debt. I mean, the default rate and the distressed rate on commercial real estate loans is ungodly. I don't think we've ever seen anything like it in this country. Not in 1990, when they had to establish the RTC to buy the savings and loan assets and piecemeal them out on a distressed basis, and not in 2008. So you've got that. Mortgage delinquencies are starting to ratchet up. I had another chart that I put in there, that said that used car loans are headed for a crisis. So, I mean, the credit system, the banking system, and the credit markets. I mean, it's a ticking time bomb, and it's not just it's not well. 2008 was about the mortgage problem, but that was a small slice of the entire mortgage market. What amplified that problem was the derivatives, and we saw that with Goldman Sachs. Goldman Sachs almost met its maker, and if Henry Paulson, which I claim is by design, wasn't in the Treasury, wasn't the Secretary of Treasury, I'm not sure Goldman would have gotten bailed out like they did. They might have let Goldman go instead of Lehman. So, I think there's any number of regional and big banks that could blow up this time. And the derivatives problem we know is worse. It's not they didn't make the derivatives market safer like they claim they did back in 2008. They just made it easier to hide the problems and hide the losses and hide the exposure, just like they did with hold to maturity securities accounting.
Well, it seems
You ready to put a gun to your head yet?
I mean, I may have hit that point a couple of years ago. I mean, it's heavy reading through the things that are going on out there, and by all means, I'm not trying to do fear porn or anything, but these are the factors that we're
It's
looking
not
at.
fear porn.
And
We're probably understating how bad things are because we don't know. They intentionally made the accounting rules and the legal rules. They made them the way they are to make the whole system more opaque than it was back in 2008.
well, like you said, it's heavy digging into this on a day by day basis, and I imagine it's heavy for a lot of people at home who are watching and seeing these things play out. And then, of course, Janet Yellen comes on TV and says the economy is rosy and everything is strong. And I'll let people know that I did send you that picture of Janet via text message last week to get that image lodged in your subconscious
Oh,
before bedtime. So fighting a little bit dirty, but yeah, it is some heavy stuff going on out there. Although I think it's better to be aware of it rather than caught blindsided like a lot of people were back in 2007, 2008 when Bernanke was saying subprime was contained and found out it wasn't. So can
we
understand.
know
Huh?
the guys that I chummed around with in chat rooms, and we were discussing all this stuff in the early 2000s, and we knew when Bernanke said that, we fell off our chairs laughing. It's not even close to being contained, pal. I mean, it's like the old Wall Street trading desk joke. How do you know when a trader is lying? His lips are moving. How do you know when a Fed official is lying? His lips are moving.
Well, I mean, if everything was fine, why would there be the need to drain the SPR, or why would there be the need for a bank term funding program? And
Exactly.
some of the signs that things aren't ideal. And perhaps maybe wrap up by saying that at least, we do have that precedent we discussed of 2008 when gold and silver fell, although counterbalancing that somewhat, we did get the recent example of what happened back in March when these banks fell, and we saw quite a surge, gold and silver, not only on the physical level, but really in the COMEX futures pricing as well. So I understand it's a bit of a tough time for people while we're watching silver hover around $21, gold back into the 1800s, although like you and I were discussing a little bit earlier, I understand it's not fun when they're down, although given some of the things that are happening and some of the longer for higher rates that we've seen could have been worse. And I think a big impact is that we are seeing the de-dollarization. We are seeing central bank gold buying, so providing a bit of a floor, especially on the gold side. So either case, we'll see what happens. Certainly a lot going on out there. And Dave, appreciate you joining me today to shed some light on some of these things. And before we wrap up, did want to mention that today's show was brought to us by Silver Viper, which I know is one that you have been looking at as they are getting set to continue drilling at La Virginia. Also, still on track for an update to their resource, which will probably be in early next year. But any thoughts you wanted to pass along today on Silver Viper, which I know you look at in your mining stock investing journal?
Yes. First of all, I just wanted to talk, you mentioned that it gets kind of heavy digging into this stuff on a daily basis. And I mean, for me, it's brutal because I every week I put a ton of economic analysis in my short sellers journal. So I got to look at these numbers, across the economy, every sector. And, when you really look at it and drill down, you see how bad the economy really is right now. It's not good. But at any rate, I actually had a bunch of subscribers emailing me about Silver Viper, because the stock, I mean, it's a 6 cents, right? I mean, the market cap is something like 12 or 13 million. It's a joke considering the current resource that they have. And the resource is going to get bigger. So I emailed Steve Cope to say, ask him what the catalyst might be, because I personally believe, and maybe I'll save this for the next podcast, the next bi-weekly podcast. I personally believe that we're setting up for a similar scenario in 2008, where we're going to get a big move higher. And to be honest, I mean, if you look at it, gold and silver, more so gold than silver, but even silver has held up remarkably well compared to what happened to it in 2008, right? And so I think the poor sentiment in the sector has to do with, I think most people who participate in the precious metal sector, are loaded up on mining stocks, and they're loaded up on junior mining stocks because it's the highest reward area if you're willing to take the risks. But there's also risks there. You don't realize the loss unless you sell it, right? So, I've got the majority of my investable funds sitting in physical gold and silver, maybe 30% in mining stocks. And that's by design, because I know the mining stocks, they're risky, even the good ones. And you got to live through periods like this. But at 6 cents on Silver Viper, there's very little downside. And if we go into the type of move that I think is coming, and who knows when, eventually, maybe before the end of the year. If it's like 2008, like I think it is, I mean, we could start to see a move next month. But a stock like Silver Viper, I think it was at 40 cents not too long ago. I think it peaked at 60 cents within the last three years.
Yeah, back in 2021.
Right. I mean, if we go into a serious bull mode in the precious metal sector, you're going to see stocks like Silver Viper that are just had holy hell beat out of them. They're going to make the biggest moves, whether it's warranted or not, right? Because it's got silver in the name, and precious metals investors seem to be silver junkies. We all are. I'm guilty. And also because they're going to make more discoveries on that property. And it'd be nice if they could get the stock price higher after this drill program and revised updated mineral resource estimate, because if they're going to have to raise money again at some point. Companies like this, you want them to have plenty of money so they can drill the crap out of their properties, especially if they've already given indication that there's economic resource on it. So, I mean, we don't know for sure that La Virginia, if the resource is economic, but it most likely is at some price of silver, maybe even economic at the current price of silver. Who knows? But eventually we're going to find out. And I mean, your downside on Silver Viper is 6 cents, right? And it won't go to zero. I mean, there's some downbid value to this project for another company. But your upside is 5 to 10 times the current price, and so why wouldn't you buy some here? And that's what I asked. I said, ask Steve what the catalysts were going to be, and he's chomping at the bit to get this drill program started. I think it'll start any day. I didn't get a chance to. I'm going to watch the replay of that webinar, so he might have talked about it in the webinar. And then after this drill, and they're going to test a new target zone, El Molino, that they have reason to believe could be very highly prospective and contain a fair amount of silver. And they're going to test drill that, and if they make a discovery there, there's your catalyst to start moving the stock, especially if the sector's in an upswing by the time these drill results come out. And then you'll get an updated resource estimate, as you say, probably sometime in the first quarter, if all goes, smoothly, and there's not any holdups at the assay labs and the independent resource estimate.
Well, I agree with what you're saying, and obviously we've seen the whole sector get hammered pretty thoroughly. Whether we're at the bottom, I suppose we'll find out in due time, but either case, certainly some good things going on at Silver Viper, and appreciate their involvement in the show. Dave, appreciate.
Got to put up chart 13 to close out the video, because this is what it's going to be like. I don't know if Tavi was the one who created this chart. If he did, it's hysterical. He posted it on Twitter within the last few days, and this sums it up. This is what it was like in 2008, right? I mean, people didn't want anything to do with gold between the end of 2008 and the end of 2009, and then all of a sudden in 2010, people couldn't get enough gold when the price had already it more than doubled at that point. So
that does seem to be how it works, and obviously the window perhaps a little empty right now at 1850, although again, with the various factors going on, and perhaps it'll take for the Fed to cut interest rates, although you've laid out a good case of why that is coming at some point. We'll see when that manifests, but
hey, I'm buying. If you don't own any silver or gold, you should buy some now. I mean, I bought more silver a couple of weeks ago, and it's the highest price per ounce I've ever paid in my life, because I think it's going to go a lot higher. What else am I going to do with my cash? I'm not going to keep it in a bank. I'm not going to keep it in a regional bank. I'm not putting it in I refuse to do business with JP Morgan. So, and another subscriber had asked me, am I still investing in T-bills? I said, no. I said, right now, I don't want to be locked in for a month, because the mining stock sector could take off at any time. It's historically cheap relative to the price of gold right now. It could start taking off at any time here. And I want to have cash ready, because I've got a shopping list that I discussed in my mining stock journal, the new issue that'll be out tomorrow. What's on my shopping list, or some of the stocks that are on my shopping list. I just bought more Viva Gold today.
Well, I hear you. And again, people can find you, as always, at Investment Research Dynamics, where you do publish the Mining Stock Journal and the Short Sellers Journal. So, Dave, I appreciate you making some time. Appreciate you being a part of the show every other week on your bi-weekly schedule. And just helpful to see the things that you're looking at, because you do go through an incredible amount of data, which you share in those journals. And I think people find that helpful to get an update from you every couple of weeks. So thank you, as always. You stay well out there, and we'll see what the next couple of weeks and months to the end of 2023 bring, but going to be interesting, to say the least. So
you stay well as well, and I'm looking forward to getting something that looks like this from you after this weekend.
Well, we shall see how it goes on Sunday. Hopefully we'll have the silver price a little bit higher one way or another, regardless of who wins the football game. But I'll look forward to texting back and forth with you some good football and silver jokes while that's going on. And
absolutely.
Look forward to catching up with you soon, my friend.
Likewise, Chris.